Welcome to the Opening Bell Report.
Okay, let's unpack this. I'm going to start this deep dive with a bit of a flashback. If I asked you to picture the stock market over the last 20 years, and I asked for the one company that defined growth at all costs, the one that burned cash, made zero profit, and just spent, who do you picture?
Oh, it has to be Amazon, without a doubt.
Right.
It was the poster child for profits don't matter.
Exactly. It's Amazon. For 2 decades, they were this rebellious teenager of the stock market. You bought the stock, you paid a huge premium for it, and you just hoped that someday they'd actually make money.
It was the ultimate jam tomorrow stock.
Yeah.
You were paying for the dream, not for, cash in the bank.
But today, we are looking at a stack of research, specifically on AMZN, trading around at $10, that says that whole era is dead. Gone. The analysis report we have here is arguing something that, honestly, sounds almost impossible. It's saying Amazon has transitioned into a high-quality value stock.
It is a fascinating pivot, and it's a little disorienting, for anyone who's followed the market for a long time. When you hear value stock, you think of a bank or a utility, maybe, a serial company. You definitely don't think of the company that's building the future of AI.
And that's our mission for this deep dive. Is this a bargain or is it a trap? Because when a tech giant starts looking like a value play, well, you have to ask questions. Is the growth over?
That is the billion-dollar question. And the report starts with this idea it calls the valuation collapse.
Which sounds terrifying. Collapse makes you think the stock price fell off a cliff.
Yeah.
But it's near all-time high. So what actually collapsed?
The premium collapsed,
Yeah.
the hype tax, if you want to call it that. We have to talk about the price-to-earnings ratio, or PE.
A classic yardstick.
Right, and for anyone who doesn't track it daily, the PE is just how much you're willing to pay for $1 of a company's earnings. It's the price tag on profit. And historically, for Amazon, that price tag was astronomical.
I remember seeing triple digits for years. It was almost a joke.
It was no joke to value investors. It was a nightmare. I mean, if you look at the 10-year average, Amazon's PE hovered around 104 times earnings.
104. Think about that. That's a century of earnings to pay you back.
It's pure speculation. You're betting the earnings will grow so fast that that number eventually makes sense.
Okay, so what is it now?
This is where the data gets shocking. Look at the current PE in the analysis report we're reviewing.
It says 29.3x.
29. From over 100 down to 29. That's the lowest valuation multiple in the company's history. The market is now pricing Amazon like it's a mature company, like a Coca-Cola or a Costco.
Wait, hold on. The market is looking at Amazon, which has AWS, Prime, this huge ad business, and saying, yeah, this is basically Costco.
Essentially, yes. The aha moment here isn't that the stock price crashed. It's that the valuation multiple collapsed because the earnings finally exploded upwards.
The company grew into its shoes.
Perfectly put.
But I want to push back a little. Is 29 times earnings really cheap? I mean, the S&P 500 average is usually closer to 20, 21. It's not dirt cheap.
That's a fair point, and it's all about context. You can't compare Amazon to a steel mill. You have to compare it to its peers. And the report does this great peer analysis, putting Amazon against Microsoft and Walmart.
Okay, so the tech king and the retail king. This should be interesting.
Right. So Microsoft is trading at a PE of roughly 31x.
Okay.
Walmart is trading around 30x. And remember, Amazon is at 29.3x.
Wait a second. You're telling me Amazon is cheaper than Walmart?
It is trading at a discount, or at least parity, to the grocery store.
Wow.
And that disconnect is what the report calls the big irony. Because think about the moat each company has. Walmart is a fantastic business, but it's retail.
Moving boxes.
Moving boxes, growing revenue at about 5%.
And Amazon.
Amazon has a cloud plus retail moat. They're growing revenue at over 12%.
It's more than double the growth.
Exactly. So you have a company growing twice as fast, with a tech monopoly attached, trading for a cheaper price than the place you buy milk and eggs.
That really puts it in perspective. The report has a great line for this. It says investors are basically buying a tech monopoly at a retail grocery store valuation.
That sums it up perfectly. And if you're a value investor, that's the kind of anomaly you hunt for. It's like a glitch in the market.
But we have to ask why. I mean, why did the earnings catch up so fast? For years, Amazon famously made no money.
Right. Jeff Bezos would just plow every dime back into the business.
So how did they suddenly become this profit machine? Are we all just ordering more toothpaste?
No, and that's the big misconception. If they were just selling more boxes, the margins would still be razor thin.
Retail is a tough game.
Brutal. The report calls this shift the profitability pivot. You have to distinguish between old Amazon and new Amazon.
Okay, so old Amazon.
Old Amazon sold goods at near zero profit to kill competition. That was the game.
And new Amazon.
New Amazon is a service-based cash machine. They're not just selling the product. They're selling the infrastructure around it. The report points to two massive engines, advertising and AWS.
Let's start with advertising because I feel this every time I search for something. The first few results are always sponsored.
You see it, and it's a gold mine. The report pegs Amazon advertising as a run rate business of over $50 billion.
And just for the listener, run rate means if you take their current quarterly revenue and just map it out for a full year. So a $50 billion a year business just hidden in the store.
Hidden in plain sight. But here's the kicker. The estimated margins on that ad revenue are 50% plus.
50%, that's insane.
Think about it. When they sell you a blender, they have to buy it, store it, ship it. Tiny margin.
Right.
When they sell an ad for a blender, it's just pixels. It costs them almost nothing. It's nearly pure profit.
So the ad business is basically paying for my free shipping.
Correct. And then you have AWS, the cloud division. That consistently delivers 30% plus operating margins. These are high-quality revenue streams Walmart just doesn't have.
So underneath the everything store is a massive ad agency and a cloud computing giant.
And the result is staggering. Operating income, that's the profit from the actual business, has exploded to $80 billion over the trailing 12 months.
80 billion.
That's real cash. And the argument is that the stock price just hasn't caught up to this new reality yet.
Okay, so they're profitable on paper, but, value investors love cash flow.
Yeah.
You can't fake the bank account balance. Does Amazon have the actual cash to back this up?
This is what's so interesting. The report calls Amazon the cash flow king. And they use a metric I think is really helpful, cash flow yield.
Okay, break that down for us.
It's simple. For every $100 of stuff the company sells, how many dollars of cash actually stay in the bank?
Got it.
Let's go back to the Walmart comparison. For every $100 in sales, Walmart retains about $6 of operating cash flow. $6. That seems pretty standard for retail. Tight margins.
It is. Now look at Amazon. For every $100 in sales, they retain about $19.
Wow. 19 versus 6? That is more than 3 times as efficient.
It's a massive difference. And this brings up a great question. Why now? Because just a few years ago, Amazon was burning cash. The report points to the logistics cycle.
Yeah, I remember this. 2020 to 2023, during the pandemic, they were building warehouses everywhere.
They were on a building spree. They effectively doubled the size of their fulfillment network in just a couple of years. Yeah. And that was a period of huge capital expenditure that just crushed their profits.
It looked terrible on the balance sheet. Investors were freaking out.
But that phase is done. The warehouses are built, the trucks are bought. Now they're in what the report calls harvest mode.
So they're just running the machine.
They're just running the machine. Efficiency is the new growth. They're reaping the rewards of the network they already built. So all that pain from a few years ago is today's cash flow game. That makes sense. But I have to play devil's advocate here. If Amazon is printing cash, trading cheaper than Walmart, and dominating the cloud, why isn't the price higher? What's the catch?
You're right to be skeptical. And a good analysis always looks at the risks. The report highlights 2 main bear arguments.
I am on me.
Risk number 1 is the AI CapEx cycle. We just talked about how they finished building all the warehouses. Well, guess what?
Now they have to build data centers.
Exactly. They stopped spending on bricks and mortar, and now they have to spend billions on silicon and servers for AI.
And that makes value investors nervous.
It depresses free cash flow, and they hate that. They see billions going out the door for generative AI, and they ask, is this a money pit?
It's the same fear from 5 years ago with the warehouses.
History rhymes. The second risk is the big one, antitrust. The government breakup threat.
Right. They're just so dominant in retail and cloud.
Regulators are watching. There's a lingering threat they could be forced to split up the company, and that scares off a lot of conservative money.
But the report has a counter-argument to this, right?
It does. It basically says these risks are already baked into the price. That 29x PE, that low valuation, that is the discount you get for taking on these risks.
So the market has already punished the stock for the fear.
That's the theory. If those risks didn't exist, the stock would probably be trading at 40x or 50x earnings. You're getting paid to take that risk.
Okay, so pulling this all together, what is the final verdict from the report? Value stock still feels a little weird to say.
The verdict is yes, but with a specific label. The report classifies Amazon not just as value, but as JARP.
JARP. Sounds like a cartoon character.
It stands for growth at a reasonable price, and it's the sweet spot for a lot of investors.
So you're not buying a dying company just because it's cheap.
Exactly. That's a value trap. And
Yeah.
you're not buying a speculative rocket that makes no money. You're getting high growth, but you aren't overpaying for it.
The report even calls Amazon a utility-like infrastructure company. That's a heavy title.
But think about it. How do goods move? Amazon Logistics. How does half the internet run? AWS. It really has become as essential as the power grid.
There's a psychological comparison in the report that I think really drives this home. It compares 2021 to now.
Right. Think back to 2021. The market was euphoric. People were falling over themselves to buy Amazon at $180 a share.
And at that time, it was earning almost nothing relative to that price.
It was all hype. Now, fast forward, the stock is around 210, so not that much higher, but now it earns over $80 billion a year in operating income.
That's the key. The price is similar, but the engine is totally different. If you liked it at 180 when it was broke, you have to love it at 210 when it's rich.
That's the fundamental argument in a nutshell.
So for the listener who's thinking about this, what does the report suggest as a strategy?
It suggests using that 29x PE as a kind of floor. Historically, when Amazon hits this level, it signals a long-term bottom. The advice is to accumulate on weakness and really watch that $200 level as support.
So if it dips near 200, the report sees that as a buy zone.
Yes. It offers a margin of safety because of the cash flow, but you still keep the upside from cloud and AI.
So to recap our journey, Amazon has graduated. It went from the rebellious teen burning cash to a wealthy, mature adult who can still run pretty fast.
A mature adult who owns the grocery store and the internet.
Exactly. And for you listening, this is a great lesson in looking under the hood. Companies change. The Amazon of 2015 is not the Amazon of today. And sometimes the market's perception lags behind that reality.
And that gap between perception and reality is where opportunity lives. You have to look at the metrics.
Before we go, I want to leave you with a thought. We talked about the risk of Amazon spending all these billions on AI. It's the big, scary monster. But remember what happened with the warehouses. Everyone hated the spending until suddenly they had the best logistics network on earth and started printing cash.
They spend big to build big. It's their playbook.
Right. So ask yourself this. If Amazon is priced like a grocery store today, but they're secretly building the infrastructure for the next generation of AI, what happens if those AI billions start generating the same 50% margins as their ad business? Are we underestimating the next transformation just like we underestimated this one?
That is the multi-billion-dollar question. And if you look at their history, betting against their ability to monetize has been a dangerous game.
Thanks for deep diving with us. We'll see you next time.
Don't forget to like, share, and subscribe for more.